India's $100 billion IT industry is at the crossroads. Growth from two of its largest markets, the US and Europe, which account for 83% of revenues, has slowed down. And the going could get worse. NASSCOM has predicted that export growth next year will be down to 11 to 14% from 16% this year. Swati D'Souza finds out what's dragging the sector down and why.
On the face of it, it's a regular hectic day at most IT companies in India. But this frantic activity is losing pace. And even though several IT companies are not openly admitting that growth is slowing down, they accept that the going is tough.
First and foremost is to operate under this uncertain macro, which is rather difficult, because whether it is a euro crisis or job situation, we have to keep watching, and we have to balance our investments and growth based on what is going to emerge out of the situation. I think that is something that companies need to watch out in near term.
See, overall, if you see businesses happening, now is it better or worse in the mood? It depends on what the mood is in that particular day. So the mood changes either becomes positive or negative based upon how Greeks behaves the previous night. So it's very difficult to judge.
But these factors have already taken a heavy toll on the IT sector, which accounts for a quarter of the country's exports of 1,24,000 crore rupees. According to a Fitch study on the financials of 5 leading IT companies, Wipro, Infosys, TCS, HCL and Mindtree, between June and December last year, the IT sector's year-on-year revenue growth had declined from 25% to about 15%. This trend is expected to continue in the current quarter too. That's because clients of IT companies have tightened their purse strings.
What happens is companies are not willing to invest for the long term. They're only investing for very short term, or they're investing in operational matters because they want to just sustain the business. And that's the reason why the slowdown has happened.
Chances are that this slowdown is not going away anytime soon. And that's why most Indian IT companies have revised their revenue guidance downward for the next quarter. Infosys has predicted sequential revenue growth of between 0 to 0.02% as opposed to a guidance of 3.2% for the previous quarter. India's fastest growing IT company Cognizant has given a sequential guidance of 3.7% revenue growth for the fourth quarter as compared to 7.8% in the third quarter. And Wipro has given a guidance of 1 to 3% quarter-on-quarter growth for the next quarter as compared to 4.5% for the previous quarter. Ditto with TCS and HCL, which have stated that the guidance for the next quarter remains cautious as opposed to 2 to 3% earlier.
I wouldn't say there is clarity beyond 2 quarters, but certainly for the next 2 quarters there's reasonable level of what we can see as a visibility, and it's at this time little difficult to say what would be the year looking like.
Indeed it will. And here it's the IT services sector which accounts for the largest chunk of IT exports that has seen the most challenging times. According to NASSCOM, nearly 85% of India's exports come from 4 sectors: banking and financial services, telecom, manufacturing and retail.
I think actually we are seeing the differences being by company and by client as opposed to by segments. Right? So for example, a lot of people predicted last year that we would have challenges in the last 2 years on BFSI. It has surprised all of us. Healthcare has been another very big growth engine, right? But I think some of the more emerging engines, if you like, or some of the historical ones that have been incredibly hit, telecom for example, still is in a challenge, right? We still want to see a greater pickup, I think, in some of the media and utility spaces that has incredible potential. We haven't seen that as yet.
A look at the size of order in the past year reveals more. Of a total 870 contracts worth $95 billion that Indian IT companies received in 2011, there were just 10 deals worth $1 billion or more. That's compared to an average of 16 such deals every year for the past 5 years.
You know, in the past, there were large deals. I think those era of large deals are only limited to some very large, managed services kind of deals. But the projects are going to be less size-wise. So I think the pipeline, as we would traditionally call it, it's not going to be longer.
From order sizes to the order pipeline itself. While companies report that the order pipelines remain strong, the situation could worsen with customers shifting spending from discretionary projects to critical maintenance projects.
To some extent, some of the discretionary spending, so that ties into maybe the services budget growth that we see, which is roughly 2 to 4% averaged across the world. So there is going to be some weakness in discretionary spending.
The industry has its hands tight, competition is stiff and the environment is tough, and that has kept margins low. With margins under pressure, IT companies are finding themselves stuck between the devil and the deep sea. They can't raise prices and new clients are tough to come by.
I think we're seeing a slowdown in overall demand. I mean, there's no question about that. Certainly it's not dramatic. It's only a couple of percentage points down, but material enough, I think, to affect the planning for all corporations.
A report by Goldman Sachs forecasts a decline in revenue growth for large-cap Indian IT companies from 19% in financial year 2012 to about 14% in financial year 2013. That's because global tech spending in the US and Europe has come down from 5% last year to 3% now. The only way out of this slowdown is to adopt a new way of thinking, which means companies will have to re-engineer processes, change their business models, and find newer geographies and verticals to stay ahead.